Hello, and welcome to our conversation on entering foreign markets. The learning objectives that we're going to cover in this brief conversation are really looking at the four basic decisions that firms need to make when they're contemplating foreign expansion. That's going to be which markets to enter, when to enter those markets, the scale at which you want to enter the market, and as well the how, the mode of entry. So let's get started. When we first start talking about which markets that you want to examine, this is where a lot of the earlier discussions on national differences would come into play. Most notably, the country's perspective on foreign direct investment, repatriation of profit, and factor endowments like education and infrastructure that you'll remember for Porter's Diamond are all important. It's also important to think about if this country is going to be a market for the goods and services that you produce, or is it more of a location for the production of these goods or the delivery of services remotely? Because the aspect of what the country is going to be might have an impact on some of these other factors, right? So let's think a little bit about timing of entry. And timing is it's not perhaps what you would think about time like a calendar. It's time relative to your competitors. You are seen as entering the market early if you get there before other non-domestic firms, and you're seen as coming in late if there are other firms in your line of business that have already established themselves in the market. And this aspect as to whether or not you are early or late has some definite implications, right? If you are first, you might be able to have some first mover advantage where you can build scale and brand recognition. It's also a lot riskier to be that first mover. That's why there's often a lot of rewards that can accrue to those that do it successfully, is because it isn't always done successfully. So there's a lot to be said for entering a market late when the product or service is established, when customers are a little more used to it. And there's nothing wrong with following, provided that you follow reasonably fast. When we talk about scale of entry, we're talking about really whether it's going to be a large or a small scale investment in the country. And firms that enter foreign markets on a significant scale, they make major commitments in terms of investment and in people to really change the competitive playing field in that market. Now, these are decisions that have long-term financial impact, and they can be very difficult to reverse. So again, kind of like with timing, when you might be a little attracted to being an early entrant, but there are some risks associated with it, this is just as true for a large-scale entry. Small-scale entry can be attractive because it lets you kind of dip your toe in the water and learn a little more about the market that you're getting into while limiting your exposure. Of course, the payback might not be as great if you go in heavy and are successful, but you're taking out a little bit of insurance to protect yourself. We're going to talk now about modes of entry, and this is really quite an important one. If you'll remember our discussion on international strategy, we're going to kind of talk about them in almost an evolutionary or a maturity model. A number of, I would say, the most popular modes of entry, we're talking about exporting, licensing or franchising, a joint venture, or a wholly owned subsidiary. And these different modes have different costs and implications. And you want to think about things like transport costs and trade barriers, right? Because that might discourage you from exporting if those transport costs are high and if barriers to entry are high. Political and economic risks might lead you to be reluctant to invest heavily in a particular market. But then also your firm strategy is going to be very important. If you're following a multi-domestic or localization strategy, like we talked about in our segment on international strategy, this might very well impact the mode that you use to enter the country. So let's maybe review these a little bit and talk about them in terms of evolution. Because if you have a wholly owned subsidiary here and exporting down here, there is kind of a subtle implication of sophistication there. Exporting is very simple. You're doing everything in your home market and you are arranging for things to be transported to your destination market. So it is pretty simple, but you have a very superficial contact with the market that you're trying to penetrate. that might not get you where you want to be. Licensing would sort of be the next step out, where you're licensing to a partner the ability to sell your products or deliver your services. This can get you some good local knowledge, and it has its own risks in that your licensee might not have the same approach to brand or service that you do. So you're not really in control of your customer experience, which is why we then move to franchising. Again, a bit of an evolution on licensing. There's a lot of similarities there, but franchisees typically have to invest more, so you're more likely that your aims and your behavior is aligned. And also it implies more maturity on your end, because you have to document things so thoroughly for people to truly understand how to make your product or to deliver that service. Kind of continuing on as we get to more costly, more time-consuming, and potentially more risky and more profitable ways of operating in foreign markets. A joint venture is a bit of a modification on licensing and franchising, where you're actually creating a new entity with a local partner to run the business jointly. And this can have a lot of benefits. I mean, you might think of it as a serious relationship or a marriage. Unfortunately, marriages and joint ventures have about the same failure rate, sitting around 50-50. So they don't always work. But if you want to take advantage of local knowledge and you're willing to make a substantial investment in the country, a joint venture could be a very elegant solution for you. Last but not least, we're going to talk about a wholly owned subsidiary. This is where you set up your company in that foreign market. And very similar to our discussion on international strategy, how transnational was a strategy that people had to evolve to, a wholly owned subsidiary is probably very similar in that you might not want to do that right out of the gate. It's a big investment. You're required to get staffed up well in a market that you might not be 100% familiar with. So multinational enterprises would always want to have a wholly owned subsidiary. It's how they get control over their brand and over their product and over the customer experience. It's just, I would urge you to recognize the fact that you probably won't get there out of the gate. You will probably use one of these more simple modes of entry. And once you've actually determined that you have success in that market and you're willing to invest more, and you've built up more experience in that market, a wholly owned subsidiary might be something good for you to consider. It's also perhaps important to think about how technology has changed a lot of these considerations of moving into different markets. The information regarding modes of entry and how you might evaluate different markets has changed subtly over the past couple of decades as technology has enabled things to happen faster. Companies do now have the opportunity to be born global as technology enables scale and disaggregation of production right off the bat. If you think about companies like Facebook and Uber and how quickly and smoothly they were able to go global and go to a number of different foreign markets, and then you think about the time it took them versus, say, automotive companies that took decades and decades to go through that same evolution. So technology is helping companies move faster in entering foreign markets. Our considerations of where, when, scale, and mode, they're still there. You still have to decide them and determine them for you. It's just now technology makes you have to make these decisions faster and sometimes with less benefit of institutional learning and experience effects. So thinking about these different modes, there is no right decision. There are just decisions that are relative to risk and reward and investment. So again, I encourage you to think about it as an evolutionary chain and to really make sure that you're keeping an eye on all four of those different factors, really understanding your national differences, perhaps applying Porter's diamond to the market in question to see its real attractiveness. Thinking about timing relative to your competitors is very, very important, as well as the scale. How much risk are you willing to bite off with regards to your investment in this market? And all of these things will then help steer you towards the best choice of entry mode for your firm at that given point in time. Thank you very much for watching.